Hi, this is John Goodman. Why am I so excited? It's because it's the fall of 2021 and the Division of Real Estate has come out with modifications to the Real Estate Commission approved contract. I should say the wonderful Real Estate Commission approved contract that will be mandatory for Colorado real estate brokers in 2022. This is one of our videos talking about what I think are the 4 important changes in the contract. So what are we talking about today? Here's the concept. The contract that you've been working with for years had a contingency in it, a loan termination contingency. And the concept was under the loan termination contingency, the buyer could consider the terms of the available loan and the availability of that loan and object to based on either the terms that the buyer could get or the availability of the loan as late as the loan termination date under the contract. That was the concept. What the Division of Real Estate has done this year, and you can check this out, is you can see in the dates and deadlines chart, that's the chart in section 3 of the contract, they have split loan terms and loan availability into 2 separate deadlines. Why have they done that? Well, my understanding is that the thinking is if time is moving this direction, the way the market sort of works right now, there's lots of variations on it, but in a garden variety residential real estate transaction, if the deal goes under contract on day 0 and the contract is supposed to close, say on day 40, that it's a common practice for under the current system for the loan termination deadline to say be a week back from the closing date, day 23. And the thinking is that buyers should be able to figure out what loan terms will be available at the time of closing, lock in those terms early in the deal so that a loan terms contingency can be gotten out of the way in the transaction early in the deal, leaving the only contingency late in the deal for uncertainty about the availability of the loan. So that was the thinking. Great concept, like the theory. But let's think a little bit about how this might play out in practice. Because imagine you are working with a buyer who is under these circumstances. This buyer is buying a home that they have the expectation that they can get owner-occupied financing on it. Why do they expect that they're going to get owner-occupied financing? Because maybe they're snowbirds and they have a house in Florida, but they're also buying a house in Colorado that they plan to occupy 3, 4, 5 months out of the year. They work with a lender, their lender has reason to think that they will be able to get owner-occupied financing. So they submit an offer and they go under contract, and that contract has a loan terms deadline that expires 5 days after MEC, 5 days after mutual execution of contract, 5 days after day 0. They lock in those terms based on the premise that they're going to get owner-occupied financing. The deal perks along, they get past inspection, they get past title, they get past insurability, they get past everything else. And now there's only one contingency left, loan availability, that is a week before closing. But lo and behold, once the underwriter, the mortgage underwriter does some more digging, the mortgage underwriter concludes that the buyers will not qualify for owner-occupied financing. And the buyers aren't keen on that. The buyers no longer want to buy the house if they're going to have to pay more, higher interest rate, perhaps more points for the financing. And so the buyers want to object. Is that an objection based on the availability of the loan? Or is that an objection based on the terms of the loan? Because after all, the buyer can get a loan. It's just not on the terms that the buyer expected. Now, I think I would rather have the buyer's side of that argument than the seller's side, but I don't know. I think there's ambiguity in this concept, and it may take a while for that ambiguity to get sorted out. So how do you manage this ambiguity? I think the answer is easy. When you're on the buyer side of this transaction, you want to ignore this distinction. You want, oh, that was a ghost or the wind opening a door, but I am going to continue with this because I believe it was the wind, not a ghost. So what you want to do is moot the ambiguity, take the ambiguity off the table, make it irrelevant. And if you're on the buyer's side of a transaction, I'm encouraging you to submit offers where the loan terms deadline and the loan availability deadline are both synced up late in the transaction, that same date that you would have otherwise set the current loan termination contingency. Take the ambiguity off the table, sync those dates up. And then what remains to be seen is how the market will respond to this. How will the market of sellers and listing brokers respond to this? Will listing brokers try and push back the loan terms deadline early in the deal? Will sellers be more likely to accept offers where the loan terms deadline is early so that sellers get that out of the way earlier? Time will tell how the market reacts to it. But in the meantime, you seek to avoid being a guinea pig, sync those two dates up when you're on the buyer side. That's how I encourage you to write your offers. Thank you for listening this long. Remember, we live in a complex world. Be careful out there.